information to our bar chart by putting an opening level and a closing level on our bar chart. In this way, even within one solitary bar, we now know what the trend within that bar was. In this case, it opened at the high and it closed near the low, so the trend was a downtrend. Start to examine the basic trend, we see that the bars can be variable lengths, and one of the keys is the distance between the opening and closing levels on a bar. If you have a very wide bar, it shows a great deal of buying power or selling pressure, and if you have the opening and closing parts of the bar in the extreme 1/3 ranges of the whole day's activity, that shows extreme pressure on that day. I know many great hedge fund traders their firms insist that if they have a stock or commodity that closes in the top quarter of a bar, they must carry the position overnight, because there is a very high probability, probably 80% or more, that a close in the top quarter of a bar will follow through in the same direction the next day, whether it be an uptrend or a downtrend. We can see this over here. There's a little downtrend developing with a big wide ranging bar with a close at the extreme high, and that represents follow through. So the up. These patterns of accumulation and distribution can take long periods of time. And so one of the principles we must ever keep in our mind, that we must assume that the trend can last forever. We can use measured moves and typical time durations. We can use planetary cycles or any other measurements, but these only give us estimates of trend exhaustion. But it's only a reversal of the pattern that's going to reverse the trend. And now, one of the most basic tools of all in trading is the use of angles. And there are many ways to draw trend lines in various angles, but we have to study the basics first so we understand why we use them. But the traditional Gann square approach is the one I use most of the time because of the geometric relationship of time and price. And an easy way to draw them that I've found is to assume that your first leg up is a 4x1 angle. And this is an assumption I'm making. I don't know what this angle is, and I don't care what it is. But usually, in many cases, if you take the first leg up that's fairly strong, and you draw a little box around it and put the first 1/4 of the box on it, then the 2x1 angle will be right in the center. The 1x1 angle would go up through the end. Now, if you look at this, you'll say, well, this is really a rectangle. It's not a square. The truth is, because the scaling factor of our prices and our time can never be perfectly scaled, at least if we draw a grid in this fashion, we can draw a quick little grid that will be in proportion with our scales. In other words, if we have like a retracement tool that we put here at the top, 100%, and divide it into quarters, 3/4, 1/2, 1/4, we know this is 100% of the move. That's the scale. If we then can have boxes drawn in it, we can drag it out and make this the 1/4. Now we have a time and price grid where from the 4x1 they top out and they go down, and the low is exactly placed at the 2x1, and we're exactly at the 50% of the range, and it catches our 1x1 angle. So it's a perfect fit. The 4x3 angle is an oddball angle. Sometimes I use these, but they're not always that important. But the 1x1 over here is the most important, because after this one is broken, you usually end the bull market. Square root of the whole move was something like this. We can now take this small unit as one box and make a big giant square. Then we can see as we come up here to the break points, we have a break point here that comes down to the 50% point, and as we near the end of the square, we have a big break that goes all the way down to the edge and catches our angle here. And then when it came back, the exact top was the top of the square. And now we've moved our first angle over to here, and we see it works perfectly. The first correction goes down to our angle, but we're still in the bull market. The bull market continues to when it intersects the top with the next angle. Then we start a bear market. The bear market goes down and bounces around the angles. And where does the bear market end? It ends exactly where it should, where the next angle hits. Then we go into a bull phase again. The bull market goes on, and where does it end? It's going to end. Now, after we get some idea of what the really big picture is, we have to have a strategy of what kind of trader we're going to be. Are we going to swing trade for long periods of time? Or much of the profit potential of trading stocks or S&P futures results from finding the right exit point. And often if you miss that exit point, it takes. So we spot check a couple of bars. The width from high to low in this bar was 19 points. Here's a smaller one for 16. Here's a relatively bigger one, 27 points. Here's 20 points. Here's a really big one, 39 points. Here's 4. So we put in the previous day's activity. So maybe draw a vertical line here. This tells you where you were yesterday. It shows you the low of yesterday and the high of yesterday. But I also like to keep track of the weekly chart. So the weekly would be 7 calendar days or 5 trading days backwards. I can instantly see, just put a vertical line 7 days back, and I can see what was the low on the weekly chart. It was yesterday. What was the high on the weekly chart? Well, in this range, the high would be up here and here at all. The other way to do it, perhaps a little more elegant, is to make two screenshots and have a little small daily chart over here with 5 or 6 days on it. So this will encompass the midpoint and closed on it, and then we gap down the next day. So the gap occurred right at the 50% of the swing. One thing that many people don't realize is that these movements from a low to a high are often repeated identically. The market never does anything different than what it's done before. It has the same measured moves, the same angular momentum, and they repeat over and over again if you take the time to study your chart. So what I mean is, from this first little low, we had a correction here. And once the uptrend started with higher highs and higher bottoms, if we take our first little top and draw a straight line from the low, and then we make a copy of this, we can either do another angle with the exact same slope, or we can just duplicate this and drag these over. And we start the next angle underneath the high at the point of the low. So as long as this low holds, we'll draw a horizontal line, we'll drag this angle over, and we'll see that this will serve as support or resistance. When it breaks it, there'll be a little downtrend. We can start another timing angle based on the same angle, and the market will respect it. And then when it breaks it, it will change the trend down a little bit. Hits it here, under this low, hits it here. So in each case, the exact same slope of the low to the high, often when it breaks it, you are at a high, and a correction ensues, even though it's only a very small correction. The other danger about using trend lines is, this is another mistake almost every trader in the world makes all the time. They think that when a trend line breaks, the trend has changed. And that's not true at all. A trend line is just an average momentum moving average, basically. If you draw a trend line on it and the trend line is going up, the trend is up. And as I've said earlier, the trend can last forever. You can break a trend line many little times and get a higher swing bottom, and it can immediately go right back up to the same trend line again, and you can break to another higher bottom. One thing to note, though, you will get a little breakdown at these trend lines because everybody uses them. But one thing about it is they don't go very far, so you don't really want to go short an uptrend when it breaks a trend line. What you want to do is have a stop on your long, so you can get stopped out and you can reposition at a lower level. If it doesn't go down enough and you haven't repositioned, you have to get back in at the horizontal placement where that trend line broke. So at this level horizontally over here, you have to get back in your trade if it goes up there, because then the trend continues again. Here's a breakdown over here, and if you weren't lucky enough to catch it on a down here at the double triple bottoms, which you should have been, or the first time it turned up, you have to get back in your trade when this horizontal level where the trend line broke occurs.